You just got a $5,000 raise, and someone at work, the office expert, leans over and says, "Careful, that might bump you into the next tax bracket. You could actually take home less." So you hesitate. Maybe you even wonder if the raise was worth it. Here's the truth, and it's not close. The extra federal tax on that $5,000 raise is just $1,050. So you keep the other $3,950. Not zero, not less than before. You come out ahead every single time. The raise push me into a higher bracket fear is the most expensive myth in personal finance. And in the next 8 minutes, we're going to end it with nothing but math. Let's use one person, one salary, one question. Meet a single filer earning $66,000 a year. Their raise is $5,000. It takes them to $71,000. Now, the top of the 12% bracket for a single filer in 2026 sits at a taxable income of $50,400. Before the raise, they're just under it. After the raise, they cross it into the 22% bracket. So the office expert's warning sounds right. They moved up a bracket. The question is simple. Does crossing that line mean the government reaches back and taxes their whole income at 22%? Because that's what the myth actually claims. Let's follow the money and see. First, a piece almost everyone skips. Tax brackets are not applied to your gross salary. They're applied to your taxable income. What's left after deductions? In 2026, the standard deduction for a single filer is $16,100. So our $66,000 earner isn't taxed on $66,000. Subtract the deduction, and their taxable income is $49,900. That already sits below the $50,400 line, inside the 12% bracket. This is step one of why the fear is overblown. The number the brackets actually touch is smaller than your salary. Now let's see how the brackets fill. Here's the mechanic the myth gets wrong. A tax bracket is not a stamp on your whole income. It's a bucket. Your income pours in from the bottom up, and each bucket only taxes the dollars that land inside it. Watch. The first $12,400 of taxable income gets taxed at 10%. That's the first bucket, and it fills for everyone, no matter how much you make. The next dollars, from $12,400 up to $50,400, get taxed at 12%. Our earner's taxable income is $49,900. So it fills the 10% bucket, then most of the 12% bucket, and stops. Their total federal income tax? $5,740. Notice what did not happen. They did not pay 12% on all $49,000. They paid 10 on the first slice, 12 on the rest. Every bracket works exactly like this, including the one the raise is about to touch. Now the raise. $5,000 on top takes gross to $71,000 and taxable income to $54,900. That does cross the $50,400 line into the 22% bracket. So does the whole income now get taxed at 22? No. Only the dollars above the line do. The amount sitting in the new bracket is $54,900 minus $50,400, $4,500. Taxed at 22%. That's $990. But watch closely because there's one more piece. Before the raise, their taxable income sat $500 below the line, so the first $500 of the raise simply finishes filling the 12% bucket. $60. 990 plus 60 is $1,050. So the total tax goes from $5,740 to $6,790. An increase of exactly $1,050 on a $5,000 raise, which means you keep $3,950 of it. Your pay after federal tax goes up by $3,950, from $60,260 to $64,210. It does not fall. It cannot fall. Compare that to the myth. If the fear were real and your whole taxable income were taxed at 22%, your tax would be $12,078. The myth invents $5,288 of tax that you will never actually owe. If you want the myth in one image, here it is. Take someone whose taxable income lands exactly on the top of the 12% bracket. Add a single dollar. $1 that crosses into the 22% bracket. How much more tax do they owe on it? 22 cents. Not 22% of their salary. 22 cents on the $1 that crossed. That is the entire mechanism. Moving into a higher bracket only ever changes the rate on the next dollars, never the ones you already earned. This is where the two numbers in the title come in. Your marginal rate is the rate on your last dollar, the top bucket you reach. After the raise, that's 22%. But your effective rate is what you actually pay across your whole income. Total tax divided by what you earned. For our earner, $6,790 in tax on $71,000 of salary is an effective rate of about 9.5%. Read that again. They're in the 22% bracket, and they pay under 10% overall. The marginal rate is the scary headline. The effective rate is the reality. And your effective rate stays well below your marginal rate at every income a paycheck earner will ever see. Take a single filer at $150,000. Their taxable income is $133,900. Watch it fill the buckets. $1,240 in the 10% bucket, $4,560 in the 12, $12,166 in the 22, and $6,768 in the 24. Add it all up, $24,734 in tax. They're in the 24% bracket, but that total is only about 16.5% of what they earned. Go higher still. A $300,000 earner reaches the 35% bracket and still pays under 23% overall. Nobody pays their top rate on their whole income. That's not a loophole. That's just how the buckets work. And this isn't just about raises. The exact same math governs overtime and bonuses. The two places the myth does the most damage. Work an extra shift, and only those dollars are taxed at your marginal rate. The pay you already earned is untouched. So turning down overtime to avoid a higher bracket simply hands back money you were about to keep. Bonuses trip people up for a different reason. A bonus check often looks like it was taxed at 40%, and people conclude bonuses are punished. They're not. That big bite is withholding, the amount your employer holds back from that one check, not the tax you actually owe. The tax you truly owe is still set by your brackets across the whole year, and any over-withholding comes back to you at filing. Withholding is a guess. Your brackets are the rule. Now think about what believing the myth actually costs. Someone declines a $5,000 raise to stay in the lower bracket. They didn't protect $3,950. They threw it away, this year and every year after, compounding for the rest of their career. The myth doesn't cost you a bracket. It costs you the raise. So let's put the myth to rest for good. 1. Brackets apply to your taxable income, not your gross. 2. Each bucket only taxes the dollars inside it. A raise is never taxed as if it were your whole paycheck. 3. Crossing into a higher bracket raises the rate on your next dollars only, so on the federal brackets, a raise always leaves you with more after tax, never less. And 4. The rate you actually pay, your effective rate, is always lower than the bracket you're in. So don't turn down a raise, more hours, or a bonus because you're afraid of a tax bracket. The bracket math only ever works in your favor. One honest caveat: a bigger income can also touch things beyond your bracket. Benefit cliffs, tax credit phaseouts, and state or payroll taxes. So check those for your own situation. These figures use the 2026 federal brackets for a single filer, straight from the IRS. Your own numbers depend on your deductions and filing status, and this is education, not tax advice. But the bracket mechanism never changes. If seeing the money move made this finally click, subscribe. This channel turns the money decisions everyone feels, but nobody explains into numbers you can actually see.